Let's be honest, trying to pick a mutual fund can feel completely overwhelming. It's like you're staring at a wall of thousands of options, and they're all screaming, "Pick me!" with their shiny star ratings. So, how in the world do you cut through all that noise and find a fund that's actually worth your money? Well, today, we're going to learn how to do exactly that.
So here's our game plan. We're going to walk through a really powerful 7-dimension audit that professionals use. We'll start by looking beyond those star ratings. Then, we'll dive into an integrity check. Basically, is the fund even being honest? After that, we run a deep quality check to see if it's actually any good. And finally, we bring it all home to deliver a clear, final verdict.
All right, first things first, we need to talk about the biggest hurdle every investor faces: how to look past the flashy marketing and find real, genuine quality. You know that feeling, right? You're looking at a list of funds, they've all got 4 or 5 stars, but you just have this gut feeling that there's more to the story. And you're right. The old way of just looking at stars, well, it just doesn't cut it anymore. But what if you could run a professional level audit on any fund you wanted right from your own screen? That's exactly what this deep analysis template inside the Finmagine AI Advisor is designed for. It's a framework that gives regular investors like you and me the tools to really dig deep and make a truly informed choice. Okay, let's roll up our sleeves and get started with the audit itself. And the first thing we have to do is an integrity check. Because before we even talk about returns, we have to know, is this fund playing fair? Is it actually doing what it says on the box? And that brings us to Dimension 1, benchmark and mandate integrity. This sounds technical, but it's really just 2 simple questions. First, if a fund calls itself a large cap fund, is it actually buying large cap stocks? And second, is it using a fair yardstick, a fair benchmark to measure itself against? Because that second point, that's a classic trick funds use to make themselves look way better than they actually are. And this is exactly what I'm talking about: the difference between TRI and PRI. The Total Return Index, or TRI, includes dividends in its calculation. It's the whole honest picture. But the Price Return Index, PRI, conveniently leaves dividends out. This makes the fund's performance look artificially high in comparison. It got so bad that SEBI, India's market regulator, actually had to step in and mandate TRI benchmarks from 2018 just to keep things fair. So, checking the official mandate is one thing, but to really complete our integrity check, we've got to look under the hood. And that brings us to Dimension 5, portfolio construction quality. This is where we stop trusting what they say and start verifying what they do by looking at the actual stocks they own. So here's what we're looking for. First, mandate coherence. Pretty simple. Are the stocks the right size? Second, concentration. Is the fund manager making high conviction bets, or are they just a closet indexer? Basically copying the benchmark while charging you high fees for it. And finally, is there a clear thesis? For instance, a fund like PPFS holds Indian value stocks alongside US tech giants. Now that might seem random, but it actually shows a very clear thesis: buy great businesses at fair prices, no matter where they are. That's a sign of integrity. Okay, integrity check is done. We've established that the fund is being honest. Now for the million-dollar question: is it actually any good? It's time for the quality check, where we look at performance, cost, and consistency. We're going to kick off the quality check with Dimension 2, and we're looking for something called alpha decay. Now, alpha is just industry jargon for a fund's ability to beat its benchmark. But here's the problem. As a fund gets bigger and bigger, that alpha can start to fade. It becomes like a giant cruise ship. It's just too big to make quick, nimble moves. So we need to check, is its outperformance consistent, or is it starting to run out of steam? Next up, Dimension 3. Let's talk about cost. Now, every investor knows to check the expense ratio, but just looking at a percentage, like say 0.87%, doesn't really tell you the whole story. We need to understand what that actually means for your wallet over the long haul. And boom, this is what I'm talking about. Look at that number. That seemingly tiny 0.87% expense ratio will quietly shave off nearly 23,000 rupees from a 1 lakh investment over a decade. This is what's called cost drag, and seeing it in actual rupees really hits different, doesn't it? It makes that abstract percentage feel very, very real. And that conversation about cost leads us perfectly into Dimension 4, AUM suitability. AUM is just assets under management. It's the total amount of money in the fund. And the big question here is, has the fund become a victim of its own success? Has it just gotten too big for its own good? This table gives us some really helpful guardrails. For a small cap fund, once it gets past about 5,000 crores, you might start to see problems. For a flexi cap, that concern zone is more like 60 to 80,000 crores. Now, the PPFAS fund we've been using as an example is sitting at around 85,000 crores, which puts it squarely in that territory. And you see how this all connects? A fund that's too big often struggles to maintain its edge, which leads directly to that alpha decay we just talked about. So the final piece of our quality check is dimension 6, which is all about consistency. Look, any fund can have one great year, but was that skill or was it just plain luck? Real quality is about being consistently good. We don't just look at the raw return number, we look at where the fund ranks among its peers. The real signal of skill is a fund that is consistently in the top quartile, the top 25%, year in and year out. Okay, we've done the heavy lifting. We've run the integrity check and the quality check across 6 different dimensions. Now it's time for the most important part, putting it all together to get one clear final answer. And that's dimension 7. It takes everything we've learned and boils it down into one of 3 simple, SEBI-compliant verdicts. Suitable is a green light. Go for it. Not suitable is a hard no, a red light. But honestly, the most interesting and often the most helpful verdict is the one in the middle. Conditionally suitable. That means it's a good fund, but there are some important things you absolutely need to know. And here is the verdict for our PPFS case study. Just look at the detail here. It's not a simple yes or no, it's conditionally suitable. But then it tells you the exact conditions. You need to be investing for at least 7 years, and you have to be okay with the fact that its international stocks might cause it to underperform its peers for a few years. Now that is an empowering piece of analysis. It lets you decide if the fund is right for you. So there you have it, a complete 7-dimension framework to slice through all the marketing hype and analyze a mutual fund like a pro. You now have the playbook, you know the questions to ask, so the only thing left is, which fund are you going to audit first?